So, have you ever wondered how big companies actually share their success with the people who own them? I mean, it's not just about the stock price going up. Sometimes they literally send a piece of the profits right to you. That, my friends, is a dividend. But how does that cash actually get from the company's bank account into your pocket? Well, let's follow the money. Here's our game plan for today. We're going to kick things off with the absolute basics, what a dividend is and why it even matters. Then we'll dive into the timeline, the key dates you've got to know. From there, we'll peek behind the curtain at the accounting, explore the fact that not all dividends are cash, and finally, we'll hunt down where all this stuff shows up in actual financial reports. All right, let's jump right in with Section 1, the shareholders' reward. Before we get into all the nitty-gritty details, we really need to get our heads around why dividends exist in the first place. At its heart, it's all about this really simple idea. Just like Farhat Lectures puts it, when you invest your money in a company, you're not doing it for charity, right? You expect a return. And a dividend is one of the most direct, tangible ways a company can look at its owners and say, hey, thanks for believing in us. Here's your share of the profits. Okay, let's break this definition down, because 3 words here are absolutely key. First, it's a distribution. Second, it comes from profits. And third, it's a reward. This isn't some random payment. It's a slice of the actual earnings the company has made, and it's being shared with the people who own the place. So where does this money physically come from? Well, it's paid out from a special little pocket on the balance sheet called retained earnings. You can think of this as the company's lifetime savings account. It's all the profit it's ever made, all piled up. A dividend is just the company deciding to take some cash out of that savings account and hand it over to its owners. Okay, moving on to the key dates. You see, paying a dividend isn't just a one-and-done event. It's a process with a super specific timeline. And for both the company and for you as an investor, timing is absolutely everything. From the company's point of view, there are 3 dates that really matter. First up is the declaration date. This is the day the board of directors gets together and says, it's official, we're paying a dividend. And the moment they say that, it becomes a legal debt they have to pay. Next is the record date. On this day, the company basically takes a snapshot and asks, okay, who owns our stock right now? That list determines who gets a check. And finally, the payment date, which, is exactly what it sounds like. It's the day the money actually goes out. Now, this brings us to something that trips up investors all the time, the difference between the record date and the ex-dividend date. The record date, that's the company's internal thing. But for you, the ex-dividend date is the magic number. You have to own the stock before this date to get that upcoming dividend. Because of a settlement rule called T+1, the ex-dividend date is now the same day as the record date. So if you buy the stock on or after the ex-dividend date, that dividend payment goes to the person who sold it to you. So we know what a dividend is, and we know the timeline. Now let's follow that money trail and see how this whole process actually makes waves in a company's accounting books. The second that dividend is announced on the declaration date, bam, the accounting gears start turning. The company makes what's called a journal entry. It lowers its retained earnings, that profit savings account, and at the exact same time, it creates a new debt, a liability called dividend payable. It's basically a formal IOU written to its shareholders. And what about the date of record? What big, complicated thing happens on the books then? Absolutely nothing. Seriously, no journal entry at all. That day is purely for paperwork. The company is just figuring out its mailing list, if you will. No money is moving, so nothing gets recorded. And finally, we get to the payment date. This is when the company makes good on its IOU. It makes another journal entry to wipe the dividend payable liability off the books, because that debt is now paid. And of course, the cash account goes down, because the money is officially out the door and on its way to shareholders. The loop is closed. We've been talking a lot about cash, but you know what? That's not the only way companies can pay their shareholders. So let's explore some of the other interesting ways a dividend can show up. I mean, it's the obvious question, right? Does a company always have to part with its cold, hard cash to pay a dividend? And the answer is a big, resounding nope. This table shows the main flavors. Of course, you've got your standard cash dividend. But a company could also issue a stock dividend where they give you more shares instead of cash. That's a great move if they want to keep their cash for other things. Then it gets even more interesting. They can issue a property dividend, paying you with things like company products or even a piece of land. And then there's a weird one called a liquidating dividend, which isn't a share of profit at all. It's the company actually giving you back some of your original investment. Now here is another classic point of confusion. A stock dividend is not the same as a stock split.
They sound similar, but from an accounting perspective, they're completely different animals. A stock dividend requires a journal entry, moving value from retained earnings over to common stock. But a stock split? It requires no journal entry whatsoever. The company just snaps its existing shares into more, smaller pieces and lowers the par value of each one.
One last thing in this section. Some people own a special type of share called cumulative preferred stock, and it comes with a serious perk. If a company goes through a rough patch and has to stop paying dividends, these shareholders get to stand at the front of the line. When the company starts paying again, it has to pay them back for all the missed payments, we call those dividends in arrears, before the common stockholders get even a penny. Okay, we have covered so much theory. For this last part, let's bring it all home and look at where you can actually find all this information in a company's real-world financial reports. Now, this is where it gets kind of fascinating because where you find dividends paid on a cash flow statement actually depends on the accounting rules the company is following. Under international rules, known as IFRS, companies get a choice. They can classify it as either an operating or financing activity. But under US GAAP, the rules are way more strict. Dividends paid must be a financing activity, period. And here is a perfect real-world example of IFRS in action. Take a look at the cash flow statement for Massmart Group. You can see it clear as day. Dividends paid is sitting right there under cash flows from operating activities. They're using that flexibility the IFRS rules give them. Now, let's contrast that with a US giant like Apple, which has to play by GAAP rules. On their statement, payments for dividends is exactly where the rulebook says it has to be, tucked neatly under financing activities. It just goes to show you how knowing the rules of the road helps you read these reports, no matter where the company is from. So after all is said and done, what's the big takeaway? It's that a dividend is so much more than just a number on a page or a check in the mail. It's a signal, it's communication. The next time you see a company announce a dividend or raise it or even cut it, ask yourself this question: what story is this company telling me about its health, its confidence, and its priorities? Because that's the real insight.